Here's a secret nobody tells you. You really don't need a six-figure salary to build real wealth. You don't even need a fancy finance degree. What you do need, though, is a rock-solid foundation. Welcome to This Explainer. Today, we're going to break down exactly how you can build that foundation for yourself. It literally comes down to just 5 rules, and honestly, most people go their entire lives without learning a single one of them.
So let's bust the biggest wealth myth out there right now. The idea that you have to be bringing in massive amounts of cash just to get started. The reality? You just need these 5 rules. By the end of our time together in This Explainer, you're going to know all 5 of them in plain English with absolutely zero fluff. No confusing jargon, just the straightforward steps that touch every single part of your money.
Here is exactly what we're going to cover. First, we'll talk about how to pay yourself first. Second, we'll break down the 50-30-20 rule. Third, we're looking at emergency funds. Fourth, debt strategy. And finally, investing early. Let's get right into it.
Starting us off with rule number 1. Pay yourself first.
Okay, so most people actually operate entirely backwards when it comes to this. They get paid, they cover their bills, they spend on whatever else they want during the month, and then, well, they try to save whatever is left over. And what usually happens? Yeah, there's absolutely nothing left. You've got to flip that order. The very day your paycheck lands, automatically move a set amount into savings or investing before you touch a single cent of it. It doesn't need to be some massive sum. Seriously, even $20 or $50 a paycheck adds up incredibly fast. Think of it like a bill you're paying to your future self. Most banking apps out there will let you set this up in under 2 minutes, and then it just runs quietly in the background. When saving happens automatically, it completely stops depending on your willpower, because let's be real, willpower always runs out eventually.
Moving on to rule number 2, the 50-30-20 rule.
This framework is a real game changer because it simply categorizes your entire financial life. Here's how it breaks down. 50% of your income covers your needs. That's your rent, your groceries, your basic utilities. Then 30% covers your wants. These are the fun things you enjoy, but, could theoretically live without if you had to. And finally, 20% goes straight to savings, investing, and debt payoff. This is exactly how you give every single dollar a specific job without feeling totally restricted and miserable. Let's ground this in reality with a quick example. Say you have a monthly income of $3,000. Following our rule, that's roughly $1,500 allocated for your needs, $900 for your wants, and $600 directed right at your savings and debt. And you know what the best part is? You do not need some expensive, complicated budgeting software to do this. A basic spreadsheet, or literally just the Notes app on your phone, is more than enough to track these 3 buckets. The goal here isn't to hit absolute perfection down to the exact penny. The goal is simply knowing where your money actually goes, rather than just guessing at the end of every month.
All right, rule number 3, build a starter emergency fund.
You really need to build this shield before doing almost anything else because life is absolutely going to throw unexpected costs at you. We've all been there, right? A flat tire on the side of the highway, a sudden medical bill, maybe a surprisingly slow month at work. Without a financial safety net, those moments usually land directly on a credit card. And when that happens, you end up paying interest on an emergency that's already over and done with. That is a vicious cycle we want to break right now. Setting a first target of $1,000 in a totally separate account is usually enough to absorb most of these daily life surprises. So here is the crucial question for you to consider. Do you have $1,000 set aside right now? If your answer is no, and if this topic is hitting a little close to home for you today, well, that's exactly why this explainer exists. Make sure you hit subscribe so you don't miss our future deep dives, where we'll give you the exact tools to change that reality.
That brings us to rule number 4. Attack high-interest debt strategically.
The truth is, not all debt is created equal. A standard home mortgage and a 25% interest credit card are completely different financial problems. To fix this, you need to list out every single debt you have right alongside its interest rate. Now, you generally have 2 main strategies to tackle this. Let's say you have a credit card at 24% and a car loan at 6%. Throwing every spare dollar at the credit card while paying just the minimums on everything else is called the avalanche method. Mathematically speaking, this saves you the most money over time because you're killing off the highest interest rates first. But what if you need some quick wins to stay motivated? That is where the snowball method comes in. With this one, you attack the smallest balance first, wipe it out completely, and carry that huge momentum forward to the next debt. Honestly, both are fantastic strategies. Picking either plan infinitely beats just ignoring the problem.
And finally, rule number 5. Start investing early.
Let's look at how this builds your long-term wealth through something called compound growth. This is quite literally the financial engine of the wealthy. Compound growth is the process where the money your investment makes starts making its own money as time passes. Because of this snowball effect, money that you invest in your 20s has decades longer to multiply than money you wait to invest in your 40s. Even small, consistent amounts can turn into a staggering sum over time simply because of how compounding works its magic behind the scenes.
Now, you might be thinking you need to be some Wall Street wizard picking individual stocks all day. You really don't. Buying low-cost index funds lets you own a tiny slice of hundreds of successful companies all at once, with very little effort on your part. It's beautifully simple. Now, as we cover this, please remember that this explainer is strictly meant for general education, not personal financial advice. Always do your own research, understand the risks involved, and consider talking to a licensed professional. But the core mechanics of this strategy, they are absolutely proven.
The entire philosophy of this rule boils down to one simple truth. Time in the market beats timing the market. You don't need a crystal ball to know exactly when to buy or sell. You just need to get started today and let the clock do the heavy lifting for you.
All right, let's bring this whole shebang together. 1. Pay yourself first by automating your savings. 2. Structure your budget with the 50-30-20 rule. 3. Build that starter emergency fund to protect yourself from life's curveballs. 4. Attack high-interest debt strategically using either the avalanche or the snowball method. And 5. Start investing early, even if it's just a few dollars a month. If you can get these 5 things right, I promise you, you're already miles ahead of most people who are out there trying to figure this all out by stressful trial and error.
So I want to leave you with this question to really think about. Which of these 5 rules will you implement today to change your financial future? Don't try to do all 5 at once if it feels overwhelming. Just pick one. Set up that automatic transfer, or finally check the exact interest rate on your credit card. Take that very first step. You've got the foundation now, so it is time to build on it. See you in the next one.